Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenivek on Bloomberg Radio.
We're going to stick with that big story of the day. And as I said a moment ago, possibly the year, Netflix buying out Warner Brothers Discovery, or at least wants to buy out. They still have some hurdles they're going to have to clear. This is an $82 billion deal if you include debt. We want to break it down now with Felix Gillette here in our studios. Felix is a media and entertainment editor for Bloomberg News and also the author of It's Not TV, The Spectacular Rise, Revolution, and Future of HBO. The perfect person to talk to about all of this. Felix, thanks so much for being here.
My pleasure.
I guess, first of all, this is sort of your sweet spot. This is your beat. Were you surprised to see Netflix come out the winner here?
Yeah, I think it was a little surprising. I mean, I think at the start of all this, Paramount kicked off this sale by making an unsolicited bid for Warner Brothers Discovery and for the whole company, right? And they rejected 3 bids, opened it up for sale. Along came Netflix and Comcast saying we'd like part of the business, not the whole thing. But I think, in spite of Netflix's strength in Hollywood, I think people were thinking, well, they only want part of it. David Ellison, just finished his deal to combine Skydance with Paramount. His father, Larry Ellison, the co-founder of Oracle, has an enormous amount of money to back the deal. So I think a lot of people thought that the Ellisons were going to be able to pull this off. And we're surprised that Netflix was able to do it.
Well, the Ellisons might still be able to pull this off because there are reports that Paramount Skydance is considering taking its offer straight to Warner Brothers Discovery shareholders. So it's not quite over yet.
Yeah, we're all waiting the next move from the Ellisons. And they signaled some displeasure yesterday in a letter to Warner Brothers saying that they felt the process had not been fair and that, sort of laying the framework for potentially going hostile.
And they bid a higher price than Netflix did too, right?
It depends. It was kind of apples to oranges, right? Because they weren't bidding for the same thing. Netflix was bidding for part of the company and, Paramount Skydance was bidding for the whole thing.
But part of the company, they were still going to offer even more for part of the company than Paramount was going to give for the whole company. Is that right?
It depends how you value the part of the company that Netflix is not acquiring, which is all of those legacy cable networks.
Well, let's talk about it since you wrote the book on HBO.
Yeah.
What would let's just say, for instance, this deal goes through Netflix, Warner Brothers, Discovery. What happens to CNN, TNT? TBS, HBO.
They'll all be spun off into a standalone company. And that's going to be, it's a declining asset, but it still throws off a lot of cash. Will it be eventually potentially combined with some of the other cable networks that are now out there? It's conceivable that someone will come along and roll up what's left of all of the traditional legacy cable networks.
And I misspoke. HBO is not part of that. That would be CNN, the cable.
Right.
The cable entities.
Cartoon Network, TBS,
right.
TNT, CNN. Yeah.
Felix, Netflix is the original disruptor. I mean, it kind of accelerated the cord cutting that we're seeing everywhere. Are we setting up for a major culture clash here by having a tech company buy a classic Hollywood studio?
Well, these deals always look great on paper, and then you start combining the assets, and often you do get culture clashes. And particularly with this company, with Warner Brothers Discovery, which was previously Warner Media, we're now 25 years into mega mergers for this company, starting with AOL Time Warner, which was one of the most disastrous, combinations in entertainment history. And then, then also the deal with AT&T buying the company later. And there was a huge culture clash there. Discovery coming along and combining assets with what remained of Warner Media also has been a turbulent ride. So, part of the question is, why would this be different? And people asked that, analysts brought that up today on the phone call with Netflix executives. And what they said is, look, we're in the entertainment business. And they didn't bring up the other companies' names, but AOL was not in the entertainment business. They were a tech company, dial-up, access to the internet in the early days. And AT&T also had, basically no entertainment industry
I thought Netflix
history.
was a tech company. That's what they tell investors.
Yeah, I mean, and they there's the famous quote of that Ted Sarandos said, early in the streaming wars, where they said, he said, we have to become HBO faster than HBO becomes us. And, I think if you look back at what's happened in the, dozen years since then, Netflix was able to master the skills of an entertainment company and how to develop original programming, how to build franchises quicker than HBO was able to master the streaming technology and distributing in this post-cable era.
I think about the culture clash, and I think about how Amazon bought MGM for $8.5 billion. And you don't hear about MGM anymore. It's kind of like it's lost its identity.
I can't imagine that would happen with Warner Brothers. But, I mean, could it? Does Netflix just become so big it overshadows these legacy brands?
Yeah, I think there's some serious questions about how these are going to fit together. And people ask today, like, what is, what's the plan? Like, is HBO going to be a standalone streaming service? Is it going to be integrated? Is it going to be like a tab on Netflix? And they said, well, hold up. We have basically a year to 18 months to figure out these questions. We're still ourselves kind of figuring out how they're going to fit together, but they see them as complementary services, complementary brands. And I think it's interesting when you think back about the past year, because in a sense, this was something that executives at Warner Brothers Discovery also came to this conclusion in the past year. They'd spent the past couple of years saying, oh, we're going to build this giant streaming service with the assets from Discovery plus assets from Warner Brothers to build a Netflix competitor. And they weren't able to catch up to Netflix in a meaningful way in terms of subscribers and in terms of the amount of time people spend on the service. And eventually, in the past 6 months, they started saying, you know what, we kind of see Netflix as a utility. Everyone has Netflix, and there's a bunch of other complementary streaming services, of which HBO Max is one. And so we're not going to try and offer everything. So in some ways, there is, other people kind of saw this coming. Maybe there's some world in which if you already have Netflix, do you buy the HBO add-on in the future from Netflix to see, the next season of Game of
another
Thrones
bundle choice is what we may have.
More bundling.
But, this is more bundling. Oh, yay. Something to look forward to.
Yeah.
Real quick, Warner Brothers Discovery has a market cap of about 64. Is it 64 million? Is that
Billion.
right? Billion. Yeah. Why do we have million here? No, 64 billion. That's right.
Yep, 64 billion.
So are they overpaying for this? Is Netflix overpaying? Because they're not getting the whole company and they're taking on the debt.
Yeah, I mean, I think the share price is down a little bit today, so I think there is some skepticism and questions about Netflix's overall strategy. Did you run out of other things to do? There have been talk in the past of, where is Netflix's growth going to come from? Well, they did this password crackdown, efforts that, people were like, what could that really do? But it was actually pretty successful. And, then they said, okay, we're going to start doing advertising, have an ad-supported version of Netflix, which previously they'd said we're never going to do advertising.
Yeah. Oh, and sports too, right?
And sports, live sports, which is part of attracting advertising. Then what's next? So what's next is this deal. And it's not that out of the realm of what they're already doing. So I think there's some question is like, paying for all that additional library, how much does that help you? Especially when you look back at, say, Disney's acquisition of Fox and their whole library, which again, huge library of really rich content, movies, TV series. And when you look back at that deal, people now think Disney maybe overpaid.
Well, certainly we know that Rupert Murdoch sold out at the right time, if nothing else. All right, Felix, appreciate your joining us this afternoon. Felix Gillette wrote the book on HBO. He is Bloomberg's media and entertainment editor.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, well, we also have data that we want to get through today, some economic data. What I found really interesting was a recovery. I don't even want to call it a rebound. It's just a bit of a recovery in consumer sentiment, rising for the first time in 5 months, although it's coming off some very depressed levels, the second lowest ever, according to the latest University of Michigan survey. Let's talk about the health of the labor market and economy now with Karen Kimbrough, chief economist at LinkedIn. Karen, you are looking at the labor economy through your lens over at LinkedIn. What do you see when it comes to job postings on LinkedIn and the take-up of those job postings?
What we're seeing right now is a labor market in the U.S. that is continuing to soften. It's not collapsing. We still see some pockets of momentum, but largely this is the labor market where employers are cautious and workers are feeling a little insecure. So, for example, when we look at our data, what we see at LinkedIn is a workforce that is adding that little badge on their profile that says, I'm, open to being hired someplace. And we saw a 20% increase. Yes, a 20% increase in members on our platform adding that badge in the U.S. alone in the past year.
Wow, that's significant.
Kind of a sign of insecurity. So despite this confidence measure you just mentioned among the consumer, what we're seeing amongst the worker is a little bit of insecurity. It shows up also in our own confidence measures where we say, how do you feel about getting a job, finding a job? And it's at this lowest level we've ever seen since we began this over 5 years ago.
Yeah, and we know that
yes.
Well, I was just going to say it's taking longer, right, for folks to find a job, which is an ongoing problem. So I'm curious to know where you're seeing the most hiring, the least hiring from your lens there at LinkedIn.
Yeah, so just taking it industry by industry quickly, some of the standout industries where we're seeing hiring pick up, it's actually positive, it's looking healthy. Tech, for one, believe it or not, is back in the black. It's positive. We're seeing hiring rates running around 6%. So tech is hiring, media is hiring. We also see it in healthcare, which has been a long-standing story of healthcare just outperforming in terms of hiring. And for obvious reasons. We see it in education. When you think about primary and secondary education, a lot of hiring going on there, not so much at the university level, though. So there are pockets where we're seeing the hiring happen. Finance is holding in as well. Where we don't see it happening, where there isn't much momentum, is construction. Think about retail, accommodation, not seeing a lot of hiring happening there. Manufacturing is looking very depressed. So these are pockets of no momentum. And I think when you put it all together, what it tells me is that we've got a labor market that is still moving forward very slowly without much momentum, but it's got a fragility to it. If we were to get a shock, it probably would be pretty rocked by it.
Wow. Okay. So that's a great way of characterizing what we're seeing right now. I think there's also frustration for a lot of job seekers, Karen, by so-called ghost jobs. There's an abundance of listings, but when people apply to jobs, there's very little follow-through on actual hiring. And it's not clear if there's a qualifications mismatch or whether maybe companies are just building up an inventory of candidates for potential positions down the road. I'm curious what you're seeing at LinkedIn.
You know what, I wouldn't put it so much as ghost jobs, but I would put it as people are finding it's taking longer to find a job. So we do see applications per applicant having been, elevated over the past year. Again, like I said, people are putting that open to work badge. They're feeling a little frustrated by a labor market where, frankly, it's a lot tougher and it's taking longer to find a job. But I don't think it's a question of just ghost jobs. I think it's a question of many more applications per job. The other thing I would say is, there is a bright spot. There are places where people are having more success, and one of them is in the small business area. So small businesses are hiring. Their hiring rate is positive relative to large businesses. So those big companies, 10,000 plus employees, they're expressing more caution. They're holding back. They want to wait and see what's going to happen with the economy, with rates, with industrial policy, with AI. But the smaller businesses are taking up the mantle. They are absolutely hiring right now.
In about 30 seconds, Karen, what's the outlook in 2026? What are you seeing there at LinkedIn? Might we start to see a bit of a loosening up and more companies willing to, expand the payrolls?
Look, what I'm seeing right now is I think that the optimism that we're seeing about the economy, the outlook from small businesses who say, look, I'm finding it actually pretty easy right now to kind of continue doing my hiring. I hope that continues. I hope that small business optimism continues because that really is a backbone for the economy. I think the bigger companies are a lot more cautious. I think that's more of a wait and see. They have a big AI play for a lot of them. So I think they're going to be more cautious.
Karen Crimbro, really appreciate your joining us. Chief economist at LinkedIn in Sunnyvale, California.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
In the meantime, when you look at the overall business environment, there are headwinds and tailwinds galore, right? You have a massive AI spending build out. You have deal making, as evidenced by today's bid from Netflix for Warner Brothers Discovery assets. You also have the prospect of lower interest rates from the Federal Reserve as early as next week. Softer job market as well, with a lot of concerns, especially from consumers, that they might not be able to spend it the way they had been because they're not feeling as confident about their employment outlook. And then, of course, there's tariffs, too, which threatens to keep prices, if not higher, then certainly elevated. So with all this in mind, let's bring in Dr. Rebecca Humkes. She is a lecturer at the London Business School, and she's at the faculty at Duke Corporate Executive Education. Dr. Rebecca Humkes is also author of Survive, Reset, Thrive, Leading Breakthrough Growth Strategy in Volatile Times. Dr. Humkes, thank you for speaking with us.
Thank you so much for having me. It's my pleasure.
So I guess the first point I want to tackle is this idea of AI, whether we're in an AI bubble. And of course, we won't know the answer until after the fact. But if AI and the excitement around it starts deflating, how much does that cast a pall over everything else that we have going on?
Yeah, the difficulty we have right now is that AI investment was the primary driver of U.S. GDP in Q2. It is the primary driver of all S&P earnings. And as you know very well, 10 companies in the S&P 500 are driving over 40% of the returns. This is incredible concentration. So if a few of these big AI hyperscalers have a bit of a hiccup, we could see a lot of the other market taken down with them. The challenge with any bubble is it's not black and white, as you know very well, Scarlett. There is shades of gray. And that's what we're seeing right now. Every time we get a market earning, if it's great, we think, okay, well, this is just more a narrative that we're in an AI bubble. If it's bad, we think the bubble's starting to burst. So we're going to see this constant swinging over the next couple of quarters every single time we get one of these earnings reports for that reason.
Rebecca, we've been talking a lot about this K-shaped economy, and you say when it comes to people in leadership positions, to executives, they should be leaning into that, right? Like playing into the K-shaped economy. What do you mean by that? What would that look like?
So we've now had several quarters of data and really a couple of years. We are very much into this K-shaped economy. There is a small percentage of customers, 10% of American consumers are driving half of spending. We've been saying this. We're actually already seeing this happen in the holiday shopping period. Now, this lower income consumer is still spending, right? We had some good data over Black Friday that they're still spending, but it's a different type of spending. It is very value-based. It is very purpose-driven. It is incredibly researched, right? So influencers and AI engines have a role to play, but we're seeing more research and purpose-driven than we have before. And it's now time for companies to say, okay, we're beyond the point that we can do more shrinkflation or one-off promotions or even worse, wait and see. And we're still seeing this reaction from some of the big players. So my guidance is step up and play, right? This lower income consumer wants real innovation. They want value. And it's time for companies to reinvest and think about what does innovation for this economy and for this consumer look like?
So for companies, does that mean the easy answer is to just make a play for the premium consumer?
There's no easy answers in a growth strategy, of course, and we are seeing some go that way. We're definitely seeing a very bifurcated economy and a bifurcated consumer. So if you have an offering for everybody, you essentially have an offering for nobody right now. This is really the time where we want companies to really think about who their ideal consumer is. Now, if it's in the luxury end, this is still a research-driven and purpose-based, but there is a lot more froth in that aspect of the market. So they could lean in there, but then we're leaving out a large proportion of the American consumer that wants innovation, right? They still want to spend, they still want to gift this holiday period. So that is a answer, but I definitely don't think it's the answer.
And as we are about to close out this year and look ahead to 2026, how should executives, Rebecca, be thinking about the new year in terms of expanding payroll, R&D, investing, et cetera, et cetera?
Yeah, the challenge is the macro data is very messy and it's very lagging. Given the government shutdown, we are really lacking that gold standard data we really need to make decisions. And we're going to see this reflected in the Fed meeting next week. Both aspects of their dual mandate are moving in the wrong way, but not so dramatically so, right? Inflation is high, but still within a tolerance level. The job market is cooling, but we're still roughly in that no fire, no hire narrative, though we might start to see some of those fires happening. And a lot of organizations, as CEOs are looking to make their growth strategies for next year, are facing this environment. The challenge that we have is we look at all of these data points to try to get a reading, is it good or bad? And that's not how we should be looking at data as executives. We should be looking at data for insights. What does this data tell me about what my growth insights are, and leading on to those? We unfortunately look at uncertainty and tend to frame it as negative or bad. And when things look gray, we assume it's going to be a downturn and start planning that way. That's not the view we should take if we want to perform in this world. It's about seeing uncertainty for what it is, a series of future events which may or may not occur. And whether or not those events are good or bad depends on what that organization is trying to do and how they're set up. So I do think on a macro level, we're going to see a real more lean into an AI investment. Many companies are really just starting to go up the curve there. R&D and innovation are looking a little bit mixed across different sectors, depending on where you're set up right now. So I think we're going to see it next year, and that'll be interesting. We're going to start seeing it coming on through earnings from next summer as well.
So, Rebecca, what is the black swan, or what's the one thing that you really worry about that keeps you up at night that you think executives, would kind of freak out over if it were to happen?
Well, executives freak out over quite a lot of things, but I tend to be a pretty prominent bull and try to reframe everything for what that possible insight would be. There's a couple of things that we should be looking for, though. This AI investment bubble right now is very much built on anticipated demand. If we get a few industry leaders, non-tech, come out and make pretty firm statements that they're pulling back from AI investment, that would have real market implications. So, of course, we're looking for that. We're also in an environment of extreme political and geopolitical uncertainty. So any big changes to more trade policy or regulatory policy that really upends industries, that could shake a lot too. So kind of anything in the AI bubble, geopolitical uncertainty, and extreme policy uncertainty. If we could get a little bit more stability in the political landscape, that would actually do a lot to helping some of the economic uncertainty and the labor market. If you actually dig into the data that we're seeing from the recent job reports, a lot of this is saying, I'm just waiting until I have a bit more certainty coming up. So again, there's lots of things that could happen. Those are the couple things I'm most looking out for.
All right. Thank you so much. Dr. Rebecca Humkes is a lecturer at the London Business School and faculty at Duke Corporate Executive Education. Alexis, we need to go back to the breaking news that we were telling everyone about just a few moments ago. SpaceX telling investors that it is aiming for a late 2026 IPO. This is according to the information. SpaceX is mulling an IPO of the entire company, in fact, according to that publication.
At an eye-watering valuation of $800 billion, far surpassing OpenAI's record-setting $500 billion. So we want to bring in Bloomberg Tech co-host Ed Ludlow, who's in San Francisco, and on top of all of it for us about this SpaceX IPO deal. First off, Ed, I guess it was a question of just when, right? Not if it was going to happen?
Yeah, I just want to correct and clarify some things for you guys. There are two distinct things here. There is a tender offer, which is an insider share sale, where basically SpaceX does this annually or biannually. It allows employees and early investors to sell shares at a specific price and therefore valuation to give them some liquidity. So the Journal had reported that this tender was at a share price that would give a valuation of $800 billion, double what we believed the valuation to be earlier this year. I'm hearing that there is a tender underway. It could close by Monday, but actually the share price I was hearing is much nearer to $300 a piece, which would put the valuation nearer to $600 billion. So this is a kind of live situation. The IPO part of it is separate. that, in communications with investors, the company is saying that in the second half of next year, 2026, they'd look at an IPO, and the bit you're right about is that it would be the whole company. Previously, we reported that one of the ideas was that SpaceX would spin off Starlink, its space-based, constellation-based internet service, rather than the whole company. But, that is contrary to what the information's put out this morning.
Right. Okay. Thank you for clarifying that. There's a lot going on here with SpaceX, and we know investors are hungry for any information they can get on it, because right now it's privately held, and so you can't really get access to it. Having said all of that, Ed, Elon Musk would be the CEO of two publicly traded companies if this happens. Does his current contract or his current setup with Tesla allow for that?
Yeah, I mean, as you know, Scarlett, we spoke to Tesla's board chair, Robin Denholm, about this exact idea twice. The board seems comfortable based on the compensation agreement, which has now been ratified by Tesla shareholders, that Musk continues on at the helm of other companies. And actually, the board went a step further to say that there's value in Elon Musk having interaction with these companies, because in the future, they basically believe they're highly analogous. If you think about space-based internet and where this market's going right now, a very big concentration on the potential for space-based data centers, they will see it as a kind of value add to have the relationship between the two companies. The technicalities of being the CEO of two public companies, no idea. That will come out in the wash, right, when they talk to investors about it. But remember that SpaceX does have highly capable executives in President and COO Gwynne Shotwell, who runs the place day to day. And then Brett Johnson, the CFO, is the guy that does all the money talk with investors anyway.
I wonder if this is going to make Jeff Bezos want to take Blue Origin public.
Ooh, good question.
Yeah, it's a great question. I mean, look, it is an expensive endeavor to first get the company off the ground, pardon the pun, for launch companies. But at this point, the difference with SpaceX is that they have changed the economics of launch and then deployment of Starlink. The reason that we talked about at one time, this was in 2024, spinning off Starlink as opposed to an IPO of the whole company, is that A, the revenues from Starlink now eclipse launch. But B, it's a much higher margin, cash flow positive business. There isn't a lot of profit to be made in launching rockets into orbit. Mm-hmm. But also, Musk has been quite transparent that it tops out. There's only so much money you can make from doing that. And so Blue Origin is much earlier in its life cycle, getting the economics right of launch, but also the other things it wants to do beyond just putting things into orbit.
All right, good stuff. Ed, always appreciate your hopping on. Ed Ludlow is Bloomberg Tech co-host, speaking with us about this report from the information that SpaceX is telling investors it is aiming for an IPO in late 2026.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's talk more about these markets with Eric Weiner, Bloomberg Senior Editor, Equities America, joining us here in our Interactive Brokers studio. First of all, happy Friday to you.
Happy Friday to you as well.
What do you make of the market action this week ahead of course, next week with the Fed catalyst?
So this week was kind of muted, all things considered. And as you point out, the Fed, that often happens right before a decision. What was interesting is looking at it from a sector level. The sectors that would be considered growth did actually really well. Energy did well because winter is coming. But you had tech do well, you had telecom doing well, you had discretionary doing well. And the sectors that didn't do well were the defensive sectors, utilities where people go for dividends. You also had healthcare falling. So people were buying into risk. They were playing into the AI trade. Salesforce did really well. So earnings still matter.
Right.
But you're waiting on this sort of all systems go from the Fed. So if you look at the setup, we're kind of ready for, as Christine said, the Santa Claus rally to come. But, there's a big caveat out there.
Yeah, well, I mean, it seems like, we've had pricing for a December Fed rate cut for a while now. It's pretty much a done deal as far as markets are concerned. What do you think we could get from the Fed that could derail this? Because, it seems like we have healthy breath. We have a good kind of base of stock movers that could take the index there if we wanted. But is there something from the Fed that maybe markets haven't priced yet?
Oh, absolutely. I mean, when you look at the action in the market relative to the Fed, the expectations for a rate cut came way down. At a certain point a few weeks ago, when we were selling off, we were at like 30%, 40% on expectations. So now we're at like 90. So right. That's where things start rising. And a lot of that is priced in. So probably a bit of a sell the news event coming off of the Fed, when they announce it. What people will be listening to is and will be looking for is the cohesiveness of the group. So, last time when you heard a lot of Fed officials saying, we should kind of dial things back, that's when people get nervous. Last time you had Powell coming out and talking about how everybody was expecting the Fed to cut this time, and Powell kind of threw some cold water on it. That scares everybody. So it's those kinds of things where people are sort of reading into what the officials are saying. They're going to start looking at where they are on the dot plots, where people are on expectations. And, if there is broad agreement that there are going to be more rate cuts, then the stock market will take off. If there's disagreement on where things are going to go, we're back in that kind of holding pattern.
Today, we got some more backward-looking data with the PCE, the Fed's preferred inflation gauge, rising 0.2% in September. I guess that was in line with estimates. Does this do anything at all for the Fed at this point, especially given the fact that it's a September number?
Yeah, that was what I was going to say. It's because we're still playing catch up. It's hard to know. It's also hard to know what they see. However, inflation is still rising, and that's really the point. So as things keep climbing and prices keep climbing, that is one side of the equation. The other thing, though, is that we are seeing kind of job softening. You're seeing some signs of economic weakness, and that is going to be the pressure for them to cut, because you kind of need to stimulate things, and you need to, it's not even just that 125 basis point cut does a massive amount. It's just the symbol, the signal that it sends to the market, which is that, we're here, we're going to be reactive, we're going to be responding to all this. And that's where traders get enthusiastic.
Now, Eric, looking forward to 2026, usually when we see a December rally, that's usually followed by a pullback in January. And so now we're there, right? Even though it's a small rally, but it's still a rally nonetheless for December. Do you get the sense that maybe investors are starting to get ready for that January pullback at this point?
Oh, I don't, actually quite the opposite. I mean, it's been strange, but we've been talking to a lot of traders who are all bulled up. We've been talking to a lot of professional investors, hedge fund managers, and portfolio managers who really want to own stocks. The question is valuations. The question is where have, the AI stocks gotten ahead of themselves? But there's a broad belief, and we're going to be writing a story about this weekend across the globe. It's not just here. It's in Europe. It's in Asia, that there's this enthusiasm for equities. I'm kind of surprised, but that is what we're hearing.
So, yeah, I mean, I'm glad you mentioned Europe, because this really has been a global and international, but also a global rally. I mean, we've even seen emerging markets do quite well. Do you see that? I guess the question is there any reason why it wouldn't continue next year?
Well, probably if the bull case plays out, you're probably not going to see European stocks and overseas stocks outperforming the U.S., which we saw for a lot of this year, which is weird, particularly when things are moving up. But you could see a global lift. I mean, the idea that foreign stocks are priced cheaply is true. So if there is going to be growth overseas, if they are playing into the technology game here, if tariffs are not weighing on costs overseas the way that people feared, then there could be room, or there appears to be room for people to step in and find some value.
Yeah, and well, maybe we can finally get the year of value that a lot of investors in Europe have been hoping for the past decade.
Europe did well this year. And that's always kind of a shock when they do as well or better than the U.S. And there is some enthusiasm for what's going on there. It's not even necessarily a value play as much as it's like there's real growth in certain sectors there that people want to be in on.
Yeah. Well, I mean, look, we're heading into 2026, right? Probably investors are kind of thinking, what happened to the Sell America trade, right?
Yeah.
Because that was something that we were talking about, in April. What do you think? Where do investors stand now in terms of concerns over that? Are those mostly gone at this point?
Well, temporarily. I don't necessarily know. We're still playing catch up with data, and we don't know. There has been a sentiment change in the way that people are viewing the economy. I mean, obviously, we got some good news on the economy today, but if you look at the University of Michigan number, it still is troublingly low. So you have a lot of people in the U.S. who are very concerned about things. If we get a broad pullback in spending, so much of our economy and so much of the market is based upon people buying stuff. And if people just stop buying stuff or even slow down, say we're going to cut 25% off of our spending, the average family goes, we're not going to do this trip, or we're not going to buy steak this time, we're going to buy chicken, or whatever it is. Those little decisions, each one of them, when you count it over 1,000 times, 100,000 times, whatever, it really adds up. And that's where we don't know. We do not know where the American consumer is. And that, to me, is kind of the big fear out there, which is if people pull back, and, right now we're being lifted very heavily by wealthy people spending. If we pull back, it could get dicey.
Yeah, and we're hearing it time and time again from a bunch of different companies in different industries. Well, this week, Kroger, Dollar General, all talking about people becoming choosier. Kroger's going to bring back the paper coupon. That's where they're at this point. But each of them, I think the trend is from Walmart on down is that the higher income shopper is now coming in and making more trips to their store and buying more.
And more to McDonald's does well. And then McDonald's starts adding cheaper meals. It's when you start seeing that and you start seeing people going, McDonald's is too expensive. That's when you begin to think, well, what is that going to mean for dining in general? What is that going to mean for what people are spending? And beef prices are very high. So there are a lot of balls in the air right now when it comes to that. And we just don't know because we haven't seen the numbers.
Eric Weiner, Senior Editor, Equities America at Bloomberg. Thanks so much, guys, for giving us your perspective today.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.